As exporters are encouraged to explore opportunities in Sub Saharan Africa, banks face a challenge to provide flexible trade finance solutions at competitive prices in a market often considered as high risk. At the UK Trade and Investment's Aim for Africa conference last week in London, small exporters expressed concern about getting financing from banks. HSBC Managing Director for Sub-Saharan Africa Project and Export Finance Richard Hodder explains to GTR how his bank deals with the challenge of supporting small businesses in Africa.
In terms of trade finance, yes, we will look at straightforward letter of credit business through our correspondent banking relationships across Africa, and so we can look at smaller size transactions. Our issue becomes when we start looking at doing the medium and long-term financing with the support of export credit agencies. It does become more challenging from just a deal throughput, the volume issue, the amount of work that it takes to do a very small transaction. We struggle from a resourcing perspective to make that business work for us in a meaningful way. But what we have been looking at is the impact of the business that we have been doing in Africa in terms of who we've been supporting on the exporter side. We've done a loan recently into Ghana where there was a $34 million loan to the airport authority in Accra for the redevelopment of the airport. And when we look back at the subcontract network beneath that, beneath the main contract which we were financing, there are 25 separate SMEs supporting the main contractor on that project. So it may be that we focus on the larger transactions, but underneath that we have a full range of SMEs being supported and benefiting in the economy.
Panelists at the conference pointed to the importance of export credit agencies in closing deals on the African market, where private insurers are sometimes reluctant to cover risks.
The private insurance market, credit insurance market, is going to be more cautious in the riskier markets, and we're there to provide cover when the private market cannot do so.
There's a role for the private insurance market alongside the export credit market. The pricing can vary slightly, and sometimes the tenors on the private market insurance don't go quite out as far as the export credit facilities do. If we can overlay the risk of our borrowers in Africa with that of a European government, we can record those loans differently in our books, which means that we can offer cheaper pricing and lend for longer terms than as if we were just providing a loan without their support. And for African business, where a lot of the development is infrastructure related, that is absolutely key because you need longer tenors.
From a UK perspective, banks and ECAs expect most of the financing demand to come from the oil and gas, construction and aviation sectors, but warn that market knowledge is crucial in Africa more than anywhere else.
We continue to support Airbus and Rolls-Royce sales campaigns to airlines in Africa. We're also seeing construction companies returning to undertake civil engineering and building projects in Sub-Saharan Africa, which we have not seen for some time.
There are UK companies doing extremely good work, landing contracts out in these markets, and the reason why they're doing that is because they're on the ground, they've got out there, they've travelled, they've made the effort to see the potential buyers of this equipment, and it's the only way that you can win and secure the business in Sub-Saharan.